Have you ever felt like you were standing outside a fancy party, looking in through the glass window? Inside, people from Wall Street in their suits seem to be playing a game only they know the rules to. Meanwhile, we, ordinary people, just see flashing green and red numbers on a screen and think, this is too complicated, too risky. Many say the stock market is nothing more than a giant casino. And if you only look at the numbers dancing every second, they're right. But what if I told you there's another way to see it? A secret that the world's most successful investors, like Warren Buffett, have used throughout their careers. It's not a complicated mathematical formula. It's a shift in mindset. A single idea that can turn you from an outsider looking in into someone confident enough to step inside that party. That idea is this. Stop thinking like a stock trader and start thinking like a business owner. In this video, I won't teach you how to read charts or predict the market. Instead, I'll show you how to install a new operating system for your mind, one built for true investors. We'll go through exactly what this mindset is, how it works, and how you can start applying it today to build the financial stability you've been looking for. So let's start with the most basic question. What exactly is a stock? Forget the ticker symbols and the flashing numbers for a moment. Imagine this. There's a coffee shop on the corner that you absolutely love. Their coffee is amazing, the service is great, and the place is always full of customers. One day, the owner decides to sell small pieces of the shop to raise money for expansion. When you buy a share of Starbucks, you're essentially doing the same thing. You're not buying a blinking ticker code called SBUX. You're buying a certificate that says you own a tiny part of tens of thousands of Starbucks stores all around the world. You own a fraction of the coffee beans, the espresso machines, and even the lease agreements for those cozy shops. You become an owner. And as an owner, you have two main ways to make money. The first is called capital gains. If that coffee shop keeps doing well, opens more branches, and increases its profits, then your small piece of ownership naturally becomes more valuable. If you decide to sell your part to someone else, you'll sell it for a higher price than you bought it. The second is dividends. When the coffee shop makes a profit, the owner may decide to share a portion of that profit with all the co-owners. It's the reward for believing in and investing in their business. That's really all there is to it. A stock is ownership. And investing is simply the act of buying small pieces of great businesses that you believe will grow in the future. If it's that simple, then why do stock prices swing wildly every single day? Why can the stock of that amazing coffee shop drop 10% in just one morning, even when nothing bad actually happened? This is where we need to understand how the market really works, and it's also the most important part of applying the owner's mindset. Let's meet an imaginary character called Mr. Market, created by Benjamin Graham, Warren Buffett's mentor. Imagine Mr. Market as your business partner in that same coffee shop. There's only one problem. Mr. Market is emotionally unstable. Every day, he knocks on your office door and offers you a price, either to buy your share of the business or to sell you more of his. On good days, when he reads some positive news, he's euphoric and full of optimism. He shouts, "Our coffee shop is the best. The future looks amazing. I'm willing to pay any price to buy your part." But on bad days, after hearing a few negative rumors, he becomes depressed and panicked. He groans, "We're doomed. Bankruptcy is coming. Please, buy my share. I'll sell it cheap. Any price you want." The stock market is Mr. Market. Every number you see on the screen isn't the true value of a company, it's just Mr. Market's mood at that very moment. Prices are created by millions of people placing bids and asks. When the crowd feels optimistic, more people want to buy, they're willing to pay higher prices and stocks go up. When fear takes over, everyone rushes to sell, and prices plunge. An average trader tries to guess Mr. Market's mood, buying when he's happy and selling when he starts to get sad. It's a game of luck. But a true business owner thinks differently. He knows the real value of his coffee shop. He knows how much revenue it brings in, what the profits are, and what its growth potential looks like. This is the core difference between market price and intrinsic value. The market price is what Mr. Market shouts at your door. It changes every second, driven by emotions, rumors, and fear. Intrinsic value, on the other hand, is the true worth of the business. built on tangible things: profits, assets, cash flow, and competitive advantage. This value changes very slowly. Sometimes it takes years to shift meaningfully. So, how can you, as an owner, figure out the intrinsic value? Professionals use complex models like discounted cash flow, DCF, or dividend discount model, DDM. But you don't have to be a finance expert to understand the essence. Just ask yourself a few simple questions. First, how does this business make money? Is its business model sustainable? Second, does it have any competitive advantage? For example, a strong brand like Coca-Cola or proprietary technology like Apple. Third, is the management trustworthy? And finally, based on the profits it generates, what would be a reasonable price to buy the entire company? You don't need an exact number, just a rough estimate. And your job as a wise investor is to wait. Wait until Mr. Market becomes pessimistic and fearful, and knocks on your door offering to sell you a wonderful business at a bargain price, far below its intrinsic value. That's when you act. What are the benefits of adopting this mindset? Why is it so important for those of us who are seeking stability? Benefit 1. Peace of mind. When you understand that daily market fluctuations are nothing more than Mr. Market's mood swings, you stop panicking when everything turns red. You're no longer pulled by FOMO, the fear of missing out, when prices soar. You focus on the value of the businesses you own, not the flashing numbers on the screen. You'll sleep better at night. Benefit 2. Better decision-making. This mindset gives you a compass, one that always points toward value. When the market is fearful, other people's panic becomes your opportunity. When the market is greedy, caution becomes your best friend. You stop reacting emotionally and start acting strategically. Benefit 3. The path to sustainable wealth. Riding the emotional waves of Mr. Market might make someone rich overnight, but it can also wipe them out just as fast. Slowly buying and accumulating shares of great companies at reasonable prices is a strategy that has been proven over decades. It's not flashy, but it works. It's how you build a strong financial foundation for yourself and your family. The stock market is not a place to test your luck. It's a place to practice patience and rational thinking. It's not an exclusive game for the elite. It's a mechanism that allows us to own a small piece of some of the best companies in the world. Don't rush to open a brokerage account or buy any stock just yet. Do this instead. Pick a company you already know and love. It could be Apple, because you use an iPhone. It could be Nike, because you wear their shoes. Or maybe Netflix, because you watch it every night. And then, start thinking about it like an owner. What makes this company great? Why are customers loyal to it? What risks does it face? If you had enough money, would you be willing to buy the entire company at its current price? Start exercising that owner's mindset muscle, because once you begin to see the market through this lens, you'll never see it the same way again. If you found this video helpful, don't forget to like and subscribe so you won't miss the next one.